Welcome back to the Investor Professor podcast. This is Dr. Ryan Peckham, and this is episode 44. Today, we're going to be going over all things Omaha, Berkshire Hathaway meeting, Warren Buffett, Charlie Munger. As many of you know, I just got back from my trip there. That's why this episode's a little bit late. I got back late last night, and so today I just want to go over all the things that were covered, give a little appreciation to Warren and Charlie for all their years of education and helping and teaching, and just kind of show my appreciation and hopefully share with you some ideas that you can take forth and hopefully implement in your life as you save money, invest money, and build your financial future. So looking forward to doing this episode. I'll see you on the other side. So thanks for joining me again. Wanted to do a report on my trip to Omaha, and the markets did terrible last week. I'll cover that maybe next week's episode. We'll discuss some market strategies, but one of the things that was apparent, this is my second trip I've been able to take to Omaha. Got to take somebody much younger than me this time, so that was fun to see how it impacted them. But you got to understand that Charlie Munger is 98 years old. Warren Buffett is 91. He'll be 92 in August. And of course, every time you go to one of these things, you think to yourself, okay, I'm going because I might not be able to ever do this again, right? And so there's many of us that go up there. It's a great sense of community. It kind of rebalances you. It gives you that anchor that you're looking for. But there's a couple things that stick out to me about, Warren Buffett, Berkshire Hathaway, and the way they go about managing money. And especially in today's time where we have markets that got a little crazy last year. Markets are obviously coming down this year. There's many companies that are down 70% already. You have everybody running to the exits. We call that getting close to capitulation, basically, which is when people throw their hands up and say, okay, I'm done with this. And, they head for the exits. And so those of us that look at this all the time, we're sitting here going, okay, well, this is when I need to go in and buy something, right? So when there's panic in the streets, that's sometimes when it rains gold, as Warren Buffett says. But one of the things, I know that many of you listening have probably never been to Omaha, Nebraska. And it's funny. So the state motto for Nebraska is Nebraska. Honestly, it's not for everyone. And it's so funny when you look at, if you study Warren Buffett, you study his, the way that he looks at things, and then you go visit Omaha and you see how laid back it is. You see how, it's not really in a hurry. Nobody's, everybody's friendly. You can totally get why, New York wasn't his cup of tea, if you will. And one of the main reasons he didn't want to be there when he was building up his business and managing money, it just did not fit his style. And so one of the things I think I've always admired about Warren Buffett is that the fact that no matter how much money he's made, no matter, it just is absolutely the same person. And I'm not sure that many of us, that if we started making that kind of money, could just stay the same and live in the same house and not increase our standard of living. I'm not saying I'm any better. I don't think I could do it. It's just absolutely amazing. And so when you go there and you see that, and you see the companies, the type of companies that he invests in and the way that he invests, it all lines up. Like, it all completely lines up. And so, when you see somebody like that and you look at rocky times, I got to say, his level of patience is unparalleled. His ability to remember things and the numbers and the businesses, like when he says that when he buys a share of stock, that he really looks at it as he's buying the entire company, or he's buying a piece of that company. Like, he means it. Like, when he's buying into that business, and if it drops, he's going to buy more. Like he is in it for the long term. And so I know that he and many of the people that follow him, when they buy a company or they buy a stock, they're going to hold that for 2 years or longer, at minimum 2 years. And so it's nice to kind of wrap your brain around that and just to kind of hone in on that, because so much of today's market is, as Warren and Charlie pointed out over the weekend, it turns into a gambling parlor where there's so many people who are just trading in and out of stocks. And you have to understand, I've said it on this podcast many times, but the number one way that people lose money in the stock market is they trade too often. But everything that you see, everything you read, talks to you about, you got to take advantage of market moves. You got to get in, you got to get out. And, when you listen to Warren and Charlie, I mean, they're preaching patience and they're preaching the long term, and they're saying, hey, you're not going to be able to time everything. And so it really kind of refocuses you on that philosophy, that investor philosophy, that you have to be in it for the long term. So, if you're somebody who's younger and you're looking to build your portfolio up, you should be thankful that the market has come down so much, right? Because it's allowing you to buy into really good companies that have come down. And, you got to be willing to go through the bad times if you want to enjoy the good times. And so it's planting seeds when things don't look so good, right? And just keeping your head down and doing your own thing and not worrying about what other people are doing. And so when you see the questions that are asked of Warren and Charlie, it's amazing how they've been able to, they truly, truly do not care what other people are doing. Like I cannot, stress that enough. They do not care what anybody else is doing. And they're just thinking about, okay, what moves are we going to make? And we'll be patient and we'll outlast everybody. And they've proven that time and time again. So, asking the younger fellow who went with me to Omaha, just saying, hey, what was this like for you? And a couple of the things that he talked to me about was, it just makes it so much more real when you see them, and the other thing is, Omaha is a great town. I think it's very underrated. But when you go there and you see that a kid that was born there in the 1930s, was able to become the richest man in the world from a town like that, you start asking, why not me? Why can't my goals come true? Why can't my dreams come true? If a kid from Omaha, Nebraska can become the world's greatest investor, investing in stocks, he talks about how he made his first investment when he was 11 years old. He's now 91, so he's been investing for 80 years, which is pretty incredible. You sit there and you go, man, if he can do it, maybe I can too. Maybe I can save a little bit more money. Maybe I can skip some lunches and invest a little bit more money and be able to kind of change my future, change my family's tree. And it just makes it more real. So him saying that it just made it more real for him, I thought was a really good kind of way to explain it, because you're able to see somebody that's given you a roadmap that, you can follow. And going back to the level of patience that they have shown, my goodness, you have to be patient in order to be successful as an investor. And I think that, as time goes by and everything's right now and hour by hour and minute by minute, it actually makes it harder for, investors to be patient, because everything around you is telling you not to be patient. Every tweet on Twitter, every Instagram post, every CNBC story, every single thing is basically telling you not to be patient. And that's exactly what you need to do. And you have to make a conscious effort to protect that and to remind yourself of that over and over and over again. Because it's hard. Like it's hard when everything's telling you to take some sort of action. This point was made like over and over again just at the meeting. So one of the things I like to do while I'm there is I'll pull up like Yahoo Finance and I'll type in Berkshire Hathaway stock symbol. and I'll read what they're reporting about the meeting while I'm there. And it's amazing how sensational, like they try to make the headlines from what Warren Buffett is saying. And so one of the questions, for instance, was, what happens if there's some kind of nuclear war? And he said that, that it's one of the things they've worried about for years. It's just one of the things that's always in the back of everybody's mind. And so, but there was really nothing he could do to kind of prepare for it if something like that were to happen. Well, immediately on Yahoo Finance, you see this breaking news: Warren Buffett doesn't have a plan for nuclear war, and it's just going, well, geez, I mean, it's not, what plan do you expect somebody to have if nuclear bombs start going off all over the world? I mean, like what answer can he give that's going to make sense? And he discusses that, he knows that, no matter what decision, a Berkshire Hathaway decision that he makes, like it's going to have his name attached to it because it makes the story better and more people will click on it. So he tries to be very, protective and very conscious of the words he uses and the things he says, because he knows that people are going to take it and run with it. Now, Charlie, on the other hand, he just says whatever comes to his mind, and it's kind of comical to see them work together. But it's nice to see, some people that have done well for themselves for this long, to be able to do it for this long. I talked to one gentleman who this was his 25th meeting that he's been to, and he said he started going when Warren was in his 70s, because he would tell himself, he's not going to be around that much longer. You never, this could be the last one. And then here he is 20 years later, still going strong. So it is pretty neat to be able to see somebody be able to go and do something they love for this long. The other part that's fun for me is that I get to be a fan too, right? And so on the plane to Omaha, 2 rows ahead of me was Monish Pabrai, who wrote the book, The Dondo Investor. He's been a very successful value investor. He and Guy Spear won a lunch with Warren Buffett back in 2008 that changed both of their lives. And so he's put out a lot of great content, has been very, just done a great job of teaching people value investing, somebody I definitely look up to, and he's 2 rows ahead of me. And no, I did not bug him. I did not want to have my own like Mike Tyson incident. Kidding, but I just, looked at him, told him thank you, and didn't bug him. But it's just interesting when you're in that room, when you're in that arena. I look down. You look down in front of the stage. That's kind of the, the section of key people, and there's Bill Gates, and there's Tim Cook of Apple, and there's just all these people there to listen to these 2 guys speak. And you're looking at these guys. You've never felt so broke in your life as when you're in that room, and you just, the amount of money that's in there is just incredible. But it is a really interesting and just a very appreciative that I can even be in the same building as some of those people. It's just a really neat moment. So a couple of things that Warren Buffett talked about, some teaching moments here that I think are important. And one of them was on share buybacks. And so the example that he used is that, how important share buybacks are. There's so many articles that are written, hundreds and hundreds of pages of articles on share buybacks, and are they good? Are they not good? But when you look at it, there's 2 ways that a company, if you're a shareholder of a company, there's 2 ways that they can actually pay you back. One is through a dividend, and one is through share buybacks. Well, when a company pays you a dividend, if you have a, taxable, a normal brokerage account, you have to pay money on those dividends. And it's great because you get to choose what you want to do with those dividends. You can either take those dividends, or you can have those dividends reinvest, which we've discussed. But the thing about the share buyback is that you don't have to pay taxes on that. It reduces the number of shares outstanding, and it allows your percentage of ownership in the company to go up. And so the example he gave was Apple and the amount of money that Apple has spent on buybacks. And just for your reference, Apple reported last week, and they announced that they're going to do another $90 billion in share buybacks. So Apple has bought back more stock than any company ever, I'm guessing at this point. And so he discussed how their ownership, because of Apple's buybacks last year, their percentage of ownership has gone up, even though they haven't bought they haven't bought any more Apple. And when you look at their percentage of ownership in Apple, just because they've done these share buybacks, it means that Berkshire's percentage of Apple's revenue has gone up $100 million just off of those share buybacks. And so he's talking about how important that is, because American Express is another company that's done this over the years. And I believe Berkshire's initial percentage of ownership was 11 or 12%, and now it's close to 20%. And it's because of all those share buybacks. So if you're patient and you invest in companies that distribute money via dividends and dividend reinvestments or share buybacks, you can make a lot of money, but you have to be patient and you have to wait until you give it enough time to be able to see the result. And so when you look at what's going on with how the market's performing, and you look at a company like Apple, and of course they're down like everybody else, I mean, this could be a good opportunity for you to buy into a great company that makes a lot of money. I think Apple's going to have free cash flow, which is money to use on whatever they want, of over $100 billion this year. I mean, $100 billion. I mean, they're not hardly... There's no other company that you can invest in that's going to have that is able to produce that much cash. I mean, it's truly remarkable. And then the other thing that he discussed was kind of an arbitrage trade, which if you go look at Activision Blizzard, and because he talked about this, it's probably going to pop tomorrow pretty hard. But Activision Blizzard, the video game company, they agreed to be acquired from Microsoft at $95 a share. And the stock is currently at $75. So the deal's already, the companies have already agreed that Microsoft's going to buy them. And so if they buy them, even though the stock right now is $75, they're going to pay you $95 a share. And so he's looking at this going, they already own, I forgot what it was, but they own a major position in the company, 9.5%. And he's saying, they might go over that number. They'll have to file some documents, but they might go over that number because he's looking at this going, Microsoft has the money to buy them at $95. Activision Blizzard has agreed to be acquired for $95 a share. So if it's currently at $75, he's looking at that going, well, that's a free $20 a share. And so, what's the catch? Where's the risk, right? Well, the risk is that something happens to it and maybe the government doesn't approve it. The Justice Department gets into, disapproves it, and they don't approve that they're going to let Microsoft buy it. But he's saying, the risk reward there, as long as you right size the position, this is kind of a good old fashioned, you could buy the company for $75, and then when the deal closes, you're going to get $95. So it could be worth, not your entire fortune, but a piece of your portfolio. You could take a chance on this, because, maybe the risk reward is good. And I was even looking at this for Twitter. So as you know, the big news story this past week is that Elon Musk has agreed to buy Twitter for $54.20, and the stock's currently trading at $49. Well, he's already announced that he's going to take it private, and he's going to take it private at $54.20. So the stock's currently at $49, and you're sitting there going, well, that's a free $5 a share. And so it's the same kind of deal as Activision Blizzard, where there might be, some government regulations, maybe they don't approve it, maybe they're, but normally that doesn't happen. And so this is those kind of risk reward trades that you're looking for, where, it allows you to be able to kind of take advantage of the craziness that the market provides. So just something for you to think about for your portfolio. But remember, Warren is not your financial advisor. I'm not your financial advisor. So talk to your financial advisor before making any final decisions, and past performance is not indicative of future results. So I'll leave you with one final story, and that is Warren Buffett, when he was younger, went to Las Vegas, and he saw everybody putting money on craps and pulling the slot machine handles and playing roulette, doing all that stuff. And he just couldn't believe that he knew, these people knew that the odds were not in their favor, and they couldn't wait to give their money away. And he said, I know I'm going to be rich, because as long as I do, the things I need to do, then people will make bad decisions when it comes to investing. And investing is basically, people, the impatient transferring their money to the patient. And I think that is such a key phrase that when you think longer term, how much better you do in the market, right? So if you think about the investments that you make today, starting to invest today, the companies that you choose to invest in, you should be thinking about how much money you're going to make on them 3 years from now, 5 years from now, 10 times from now. Because especially if they have a history of increasing their dividends, if they buy back shares, the longer you hold that company, the better you're going to do. And so many of us need to be reminded of pushing our time horizon out or just thinking longer term, because it's so easy to think about what's going to happen 3 days from now, 3 weeks from now. But the further you go out, the harder it becomes. And so we have to train ourselves. We have to make a conscious effort to think about, okay, if I buy Apple shares today, what's that going to be worth in 3 years, not in 3 months? And so, the greatest investment that you have is yourself, right? Your ability to earn money, your ability to save money is what is going to propel you and your family. And so, think of it's the same way with these companies. Like you get a college degree, you do something where you invest in yourself. You're not expecting to get a return on that investment in 1 year. You're expected to get a return on that investment over the years. Well, it's the same with companies, right? So just like you let yourself mature and you know that you're going to make more money later on, right? Most people, they hit the peak of their career in their 50s or 60s. That's when they make the highest, that's when they peak out earnings wise, most people, unless you're like an athlete and you do it in reverse. But that's when most of us peak out. Well, it's the same thing with your investments. If you buy Apple today or whatever investment, I don't need to give a specific name, but whatever investment you buy today, think about what you're going to make on it in 25, 30 years, not what you're going to make on it next week. And if you do that, you'll make better decisions and you'll invest in better companies that you know are going to be around. And that's what we have to be reminded of, because we see sparkly new things and we say, oh, I want that. But, pick things that you think are going to be around. If you think about companies that you want to invest in that you truly believe are going to be around 20 years from now, you'll make better decisions. Because when I talk to students, when I say, hey, if you invested in, XYZ company and you couldn't touch it for 20 years, would you do it? You start thinking differently about what companies you want to invest in, because you start realizing which companies might just be a fad and you stay away from those. Well, that's what you need to do. That's the thought process you need to have. So, my assignment for you this week, right? If you don't know anything about Warren Buffett, if you don't really know anything about his story, HBO did a documentary on him called Becoming Warren Buffett. And it came out in 2017, and you can now watch it on HBO, it's on HBO, but you can watch it on YouTube for free. So just go to YouTube and type in Becoming Warren Buffett and watch his documentary. And I promise that you'll enjoy that, and it'll teach you a lot about his mindset, his demeanor, and all the things that have made him so popular. And then once you do that, look up Charlie Munger and try to learn something from him too. So anyways, I hope you all had a great week. We'll cover some more market stuff with the craziness next week. We have the Fed announcing this week on May 4th. We have the podcast's first birthday coming up this week, so we'll talk about that next time. But I hope you all had a great week. Don't mistake activity for achievement, and I'll see you next time. Thanks, everybody.